So with base interest rates increasing month after month after month right now, it means that both mortgage rates and savings rates have increased. So there's really, really cheap deals that were available on your mortgage. They're now gone. Still cheap in comparison to maybe like 10 years ago, but compared to just a year ago, they're not around anymore. Whereas saving rates finally starting to see some movement. But you're not seeing them increase at the same rate. And mortgage rates, probably unsurprisingly, because that's how the banks are making money rather than giving you money, they have increased at a faster rate than the savings rates. So what should you do with your spare cash? If you've got a mortgage, should you be overpaying it with your money, or is it better off in savings? So in this video, I'm going to take you through some of the questions you might want to ask yourself, look at your situation, decide which one is the best one for you. And before you go to the comments and start saying, what about investing? What about pensions? I'll talk about that in a different video. This is purely about spare cash for overpaying your mortgage or spare cash to go into savings. Some of the stuff will be the same, but we're going to focus here on those two options. So the first thing you've got to ask yourself is, do you have any debts? Credit cards, loans, whatever it might be, an overdraft. These can all be very, very, very expensive ways to borrow money. Overdrafts could be at 40%. This is your priority, okay? So the either or of savings or overpaying mortgage, actually there's a third option here. Clear those debts. So whether you've got a lump sum right now, you've got a stash of cash, use that to wipe out those debts, either ideally completely or even as much as you can, or whether it's every single month you've got some money coming through, clear those debts. Few exceptions, maybe your student loan, and maybe if you've got some 0% credit for 18 months or something like that, then those things obviously aren't a priority. You really want to get rid of those ones, the expensive ones, because the rates you'll be getting charged on those are going to be way, 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 way more than you're going to get either on your savings or on your mortgage. So that's the first thing to do. Number one, check if you've got any debts and wipe out those. Next one down, have you got an emergency fund? I say this all the time, but it's so important. I'm going to reiterate it. This is the money that you need. And this is like over the last few years, this has been kind of really highlighted more than ever. But if you can't work for whatever reason, or you lose your job, you've got to pay those bills. The money's got to come from somewhere. So you want to start saving for that as a priority. Don't put it into the mortgage, put it into an account that you can access. Easy access account, really, really important there, because if it's locked away for a year, well, then no point, is it? So money you can get, maybe a notice account for some of it, but effectively put that money away. And this fund that you've got here for covering your mortgage, for covering your bills, for buying food, making sure you don't starve, that money also can be used if the boiler breaks or the MOT fails. So you've got that money there, and then maybe after that you start building it up again once you've used it. Hopefully you won't need it, but it's there in case you need to. Now, this shouldn't be an unlimitless amount. You really want to focus here. Okay, it depends on your situation. The general rule is 3 to 6 months of expenses, essential expenses. So you could get through a harsh period, either get a new job or get fit enough to go back to work, hopefully. You know, obviously the pandemic was a completely kind of different take on that. And in that situation, if you're worried about something really, really long term and your income is maybe a little bit irregular, so like I'm a freelancer, I don't have any kind of regular money coming in. I do, but it could disappear at any time. Well, if you're like that, you might want to think, actually, I want more than 6 months. Maybe I want a year's worth so I can weather a storm of at least that long. Hopefully, fingers crossed, you wouldn't need to, but if you did, it's there. But that's kind of what you do. So the next one here, the winner here, absolutely is savings. Make sure you've got that emergency fund. Because if you wanted to put that extra money into your mortgage, it's going to be very hard to get it out in the event of an emergency. It's not impossible, but you're probably looking at, remortgaging or equity release or something like that, which can be very, very expensive and also not necessarily easy to get done. To sell your house, to downsize, to get some cash, well, someone's going to want to buy it at the price, and again, there are fees there as well. So again, not one for you. And the saving doesn't stop here as well, because if there is anything on the horizon, sort of short to mid-term, or maybe even slightly longer term as well, where you're going to need a decent amount of money. Now, that could be something from like in 4 months' time, you're going on holiday, you want to have a fund available, or Christmas, later in the year. You want to ensure that you have enough money to cover that and get everything you need to do for that. But absolutely, this is more saving you need to do right now rather than put it into your mortgage. I think it's slightly further ahead. Could be big things. Maybe you want to redo the kitchen. Maybe you're going to buy a new car. All those kind of things. Again, you want to be able to have access to that money at the best interest rate you possibly can. You want access to it in that kind of short to medium term. If it's longer term, 5 years away, where you might need to get hold of that cash for those expenses, and likelihood is that's not really going to happen in this scenarios we're talking about here. But if there was something, then maybe you want to talk about investing. But as I said, that's for a different video. This is short-term expenses that are coming, that you will need the money for, save for it. You do not want to be overpaying your mortgage then. Next though, let's assume, right, you've got your debts all cleared, you've got your emergency fund, and you know that any expenses that are on the horizon, you've got the money saved for it, or you're going to be saving regularly for it from your salary. That money's going to be put aside every month, and when you need to pay for it, you can. Let's assume that's all in hand, but you've still got some cash left over. Well, maybe this is the time to overpay your mortgage. Well, there's a few different options here, and we'll take them turn by turn. These aren't mutually exclusive, these next ones we'll be going through. Those ones before, do those first, and after this we're like, well, maybe, but let's consider all these options. The first thing I want you to do is to compare the interest rates. This is the maths version of overpay your mortgage versus put it in savings. Because the one with the highest rate, that's the one where your money wants to go. So let's say your mortgage is at 3%. And the best easy access savings account you can get is, well, right now, time of recording this is 1.56%. Putting the money into the 3% mortgage, let's say it's £500 a month, that will generate you £97 over a year. Okay, nice amount of cash. That's a saving effectively. You won't see the money, but that's how much will be knocked off. Interest will be knocked off your mortgage. If you put that same £500 a month into an easy access account at 1.56%, it's just over half that amount at 51 quid. So mathematically, you can see that putting the money into the higher rate mortgage makes sense. Of course, if it was the other way around and you get a higher rate on your savings, then you might want to prioritize putting your money there instead. And actually, it might work out that it's a mix of the two. So the best regular saver right now is with First Direct, which is 3.5%. The most you can pay into that is £300 every single month. Well, that is 3.5% is better than 3% on this imaginary mortgage we're talking about here. So you'd want to focus on that, put as much as you can in. But if it was £500 a month you've got spare, well, 300 into the First Direct regular saver at 3.5%, and then 200 into the mortgage at 3%. So you flip it around based on the rates that you can find and the situation in hand. So in this case, there is no clear winner. It really depends what's most expensive. And I guess it depends on when you got your mortgage, if you fixed for how long. There were some very, very, very cheap deals available just a year ago. So you might find that actually that is well below the rising interest rates right now as they stand. Whereas if you're all coming to the end of a mortgage or you had one for a long, long time, you might suddenly find the new fix that you go for or the tracker. That's a lot more expensive. Again, you check this all out and make your decision that way. Now, there's one more question to ask yourself when it comes to the interest rates. The little factor you have to put in there. And this is, do you pay tax on your interest? Now, the vast majority of us do not, okay? There's something called the personal savings allowance, which I've spoken about in another video that you can check out after this, which means that if you're a basic rate taxpayer, you get £1,000 interest a year that you can earn before tax is taken off. So if you don't earn more than £1,000, you never pay tax on that interest in that year. And if you're a higher rate taxpayer, that drops down to £500. Most of us are going to be fine with that, particularly with the interest rates and savings so low as they are right now. Even though they're increasing, it still requires a lot of money to get there. But it may well be that you do pay your tax and your interest. In that case, you need to factor that in, that comparison we spoke about just now. Now you might be thinking, Andy, right, fantastic, that's really, really clear. If the rate's higher on the mortgage than the savings, I put the money there. If it's higher on the savings, I put it in there. But sometimes there might be situations where the savings rate is better, the higher than what you're paying on your mortgage, but you want to actually prioritize putting that extra cash into your mortgage. And this comes down to when you're coming to remortgage. Okay, this actually could save you a huge amount of money if you put more money in advance. And this is because, okay, let's take an example. When you bought your house, you put a deposit down. And let's say you put a 10% deposit down on your property. That meant you had a 90% mortgage. And what actually the technical term is, it's 90% loan to value, LTV. Now, I've got a whole video talking about this in remortgaging, so you can watch that one for more information, but I'll give you a quick summary here. So you've got at start 90% you owe, 10% you own. That 10% is your equity. Every month that you put money into your mortgage, you're paying off some of the interest, but you're also putting money into that and increasing that equity. So over a year or so, or a couple of years, depending on the size of your mortgage, maybe all of a sudden you've got 11% or 12% equity. Your LTV suddenly drops down to 88% from 90%. Now, why is this important? Well, every time that you go to get a new mortgage deal, the lower rates tend to happen for people with a larger LTV. So, a lot more equity and a smaller loan. And these generally start off maybe 95% down to 90%. They go down in tiers. They're not kind of each 1%, it's tiers. So then 90% might drop down to 80%, maybe to 75%. The lowest one it goes down to is 60%. But as you jump down those different tiers, you'll get access to much, much lower rates, which means over the course of that deal, whether it's a fixed deal for like 2 or 5 years, or maybe it's a tracker for the entire length of the mortgage, whatever it might be, you will be paying less interest as it goes along. And that can save you a huge amount of cash. So what you might want to do is funnel more money into the mortgage via overpayments so you can get down to that next tier. Because let's say you're on 82% right now. That's so you've got 18% equity, you've got 82% LTV that you want to borrow. If you can overpay in the next couple of years, or whatever it takes to get you just below that, to 80% is the tier, but ideally you want to go a little bit below that, suddenly you've got access to even more deals. So you might want to prioritize overpayments there. It can make a big, big difference. But again, check out that video about LTVs, which explains it in a bit more detail. The next one to consider here, again, if you're thinking, fantastic, I'm going to funnel all my money into the mortgage because I've got my emergency savings and the rate's better. Can you overpay? Really basic one. It's a really important one to consider though, because not every mortgage will allow you to. And some of the ones that do allow you to may well have a limit. Now, typically this is around 10% of the amount you owe every year. And if you pay more than that 10%, you'll get hit with some charges. And likewise, if you're not allowed to overpay and you do, again, you'll be hit by some charges. Or you might do, like I have, a mortgage that you can overpay as much as you want, whenever you want, and there's no real penalties. So this, again, really, really consider this. If you are going to be overpaying and it goes beyond that 10%, if that's what it is for your mortgage, then you don't want to be doing that. You want to stop it at that amount, stop it at that 10%, and then put the money instead into the savings account, even if the interest rate there is lower than what you're paying on your mortgage. Like I say, it's not always clear cut. Now, there is another thing to consider here as well when we're talking about the limits that might come into play. And even if there is no limit with overpayments, is there an early payment charge? Now, that one you have to factor in as well, because you don't want to suddenly say, right, I'm going to funnel all this money in, clear my mortgage, 10 years early, eventually, whatever it might be. And suddenly like, well, thank you for doing that, but because it's early, we're going to charge you a sum of cash, normally a percentage of the property, the original loan that you had, as a penalty, because they don't want you to do this. So bear that in mind, check out what all the details are. What you might be able to do, if you're suddenly kind of thinking, right, I'm going to overpay, and it's going to potentially at some point in a few years' time, whatever, bring up one of those charges, is again, on the deals, the length of the deal as well. It could be a short-term deal, it could be a longer deal, whatever it might be. See if the lender will let you renegotiate how much you've got to pay. So maybe right now you're paying £500 a month as your normal payment. But because of your overpayments, if you kept doing that, it would do it really, really quickly. Maybe they can reduce it to, I don't know, 50 quid. Basically, however long is left to the end of the mortgage, but a much, much lower payment. You can save yourself some cash that way. Again, they don't all have this, but it's certainly something to consider. You also need to think about when it comes to choosing if you want to overpay your mortgage today or put it into savings today, is when is the interest calculated on your mortgage? Now, most mortgages, they're going to do it daily. Okay, it doesn't really make a difference. Potentially, you might have one that does it monthly or quarterly or even annually. And then when they do that, they'll calculate how much interest is owed on the amount that's left, the balance you've got left on the mortgage, the loan that's left. And they'll charge that for that next period. So if it is every single year, they go, right, you owe £100,000 right now. The interest you owe on this is X. They will add that to your mortgage, and that will be going through for the next year until they reassess it. So even if you start overpaying your mortgage throughout that year, it's not going to bring down the interest that you owe for that period. That year, you've already done it. So what you want to be doing instead is maybe put that money into savings, getting the best interest rate you possibly can, and then a couple of days, a week, whatever it is, before that interest is calculated and before it's then added to your mortgage, then take that cash out and overpay it. Most people, this isn't going to be a problem, but it's definitely worth checking what the rules are on your mortgage just in case. So, quick summary here. Priority for your spare cash when it comes to savings or your mortgage are first of all to make sure you don't have any debts. Then you want to make sure that you've got an emergency fund build up, so savings wins there. Then you want to think about anything else you're going to need to spend some money on to avoid borrowing. Again, savings wins once more. After that though, it becomes down a bit more depending on different factors. What one is charging the most interest? Whichever one's higher, that one mathematically is the best one to go for. But you also need to check, are you allowed to overpay, and are there any penalties for you doing this over a certain amount? In which case you might want to split it up a little bit. You need to find out what difference overpaying now will make to the equity in your property in terms of those tiers, that loan to value ratio, to hopefully get you better deals, in which case that could be a priority over savings. You also want to make sure you know exactly what the situation is when it comes to overpayments. Are you allowed to do it full stop, or are you limited in a certain way? And if there are limits, then obviously you want to prioritize saving once you go beyond that. And the one I said just now, you want to make sure you know exactly when interest is added to your mortgage, because if it is on an annual basis or even a quarterly basis, then you might want to save that cash and time the overpayment until just before the interest is calculated. I will be back with another video very soon looking at overpaying your mortgage versus investing and your pension. So make sure you hit subscribe so you don't miss that. My name is Andy Webb. Check out these videos to help you more with your savings. I'll see you again soon.